Hi, everyone. This is Jeff Prasen with Interactive Brokers. It's my pleasure to welcome back to our podcast studio from Market Chameleon, Will McBride and Dmitry Pargamanik. Hey, guys, how are you?
Hey, Jeff, thanks for having us.
All's good, Jeff. Happy New Year, my friend.
Happy New Year, guys. And, always one of the, highlights of my months to have you guys in for the monthly webinar. And then when you guys swing by the studio afterwards, we do a different dive on the subject. And today, we had the pleasure of listening to your webinar on open interest. And for our viewers, I think it's best to start because open interest is tricky, right, guys? Maybe just if you guys could start with the fundamentals of it, it's sort of not an odd subject, it's the wrong word, but it's sort of different. It's different in volume. So people, I think, get newer traders get a little bit confused. So if you can kind of give them the key distinctions, so Will and Dmitry.
Yeah, thanks, Jeff. And yeah, I think the important thing to understand is open interest and options. It's not the same thing as volume. Volume is trading volume, which just represents, the contracts that are transacted on a day. The open interest, on the other hand, that's a calculation by the Option Clearing Corporation, and it represents the amount of contracts still open, not closed yet. So these are cumulative over time, not just on the day's trading, but these are contracts that are still held, not closed or expired by market participants. And they'll accumulate throughout the open interest can climb from, day to day or decline, but this is the total number of open interest over time.
And so maybe kind of like a practical example would help. So, what does it mean? Or can you explain when, let's just say 50,000 contracts trade in a strike, but at the end of the day, the open interest only increases by 5,000, versus, either 25,000 or 50,000 or whatever.
Yeah, no, that's it. And that's a good question. A lot of people look at volume and think that the volume automatically, updates with the open interest, and open interest is not actually updated like transactions in real time. Open interest is calculated overnight based on settled trades. And when we look at the volume throughout the day, well, you could have volume that does increase open interest. You could also have volume that is open and closed on the same day. Look at short-term trading activity where by the end of the day, the open volume in the morning is closed by the end of the day. That will not increase the open interest the next day. Or you have volume that is traded, but it's just transferred from one, risk transferred from one trader to a different trader. But if that open interest existed, that will not increase open interest as well. So you can see a lot of volume on the day, and then the next day you'll see perhaps very little open interest, but it will not correlate, to that entire day's volume from the previous day.
And could you, kind of explain why open interest, it might matter even more than volume, sort of when assessing trader sentiment?
Yeah. So the interesting thing about the open interest and what it tells us is that these are positions that are held, in risk held currently in the marketplace by players. So it shows conviction. And open interest, unlike volume, we could, trade in and out and close out of the position. But the open interest is indicating that this person, the people still carry this risk. They still have opening positions. And it could tell us a lot of things, especially if we're seeing open interest, not volume necessarily, but if we see open interest climbing, that could indicate where there's an accumulation, a buildup of risk over time, declining with exiting. And that doesn't always correlate with volume, because we could see a lot of volume on a day from day to day with open interest, not growing. So that's, the open interest tells us something different than the volume. And it's important to look at it from those perspectives.
And kind of to go further on that point, like when you see open interest increasing, are you able to determine, whether it represents like new bullish positions or bearish positions or, hedging activity, or even, can you use open interest for multi-leg strategies? like what other data points do you use to
Yeah.
decode trading?
Yeah. So when we look at open interest, we can look at it as an aggregate as open interest, like, for example, in this specific stock increasing across the board. And then we can look at it at granular levels where is the open interest increasing, but it's concentrating a particular option, or a particular expiration or cluster of options. And while we don't know the intent of each trader, who the traders are, that's anonymous, but there are certain places where if we see, open interest increasing on, a particular expiration or a particular strike, you can make inferences, where, if we're seeing open interest increasing on mostly out of the money calls, so what's happening in those calls? Why are people, particularly interested in this call? Is, because each call or each expiration, tells you something different. And that's kind of like where we start at the top and then have to dig deeper to make more inferences. Well, where is this increase in open interest coming from? Is it concentrated? Is it dispersed, amongst many different options? Is it concentrated in expiration? So those are the types of things where you would start to do more granular research.
And then on the other side of that, if open interest is decreasing dramatically, especially if it's, going down dramatically, what are some scenarios that could drive that?
Yeah. So when we see open interest decreasing dramatically, really it's indicating that people are really exiting positions. They're closing out positions. And you'd see that a lot of times, typically like after earnings announcement, where open interest grows either due to hedging, speculation, whatever. Then right after earnings, you'll typically see trading activity that ends up in open interest decreasing, which just gives you the indication that those trades were based on that event. Whatever that happened during that event, the next day, those positions are just being closed out. Win or lose, they're exiting that position and moving on. They're not holding on to those, options for longer term goals.
And, I know we talked in the past about, difference between smaller trades or big block trades. Like with open interest, is there, implications of it rising from like a huge, large block trade or, like hundreds of small scatter trades? Like,
Yeah.
how does that distinction kind of, change your interpretation of it?
Yeah, exactly. When we take a look at the open interest increase, we try to understand, well, what led to that increase? How did the trading or what type of trading led to that increase? So if we go back and look, we could look at the volume or the breakdown in the volume. And sometimes what you'll see is a open interest increase, and it was due to a very maybe one block trade, say 1,000 contracts traded on a day and open interest increased by 1,000. And if it was one transaction, that indicates, well, there, two parties, opposing parties that did a trade, and it could indicate, a large institution, a large hedge fund or whatever it is, did a trade for whatever reason they had to, could be sticking to a certain strategy, a hedge. And we could also see something different where open interest increase, but there was a lot of different scattered trades throughout the day, small trades that accumulated. And that could tell us something different where maybe something's going on where lots of people are paying attention to something reading something, they're reacting to something where it's coming from different places and it's gotten attention, either retail traders and professional traders. It could be a mix, but the behavior, the way that the trading activity throughout the day led to that open interest can tell us something different, behind those trades.
So, I mean, I know we've talked about it a million times in our podcast in the past, but really, I think the key takeaway is that in analyzing option activities, really, there's so many data points at your disposal, whether it's open interest, whether it's the volume, whether it's time and sales, and other items. So you really have to look at everything. You have to look at the full picture, to, be able to kind of formulate an opinion, and, versus just looking at one data point doesn't tell the whole story by any means.
Yeah.
And, that being said, like, are you able to identify, like, through open interest, multi-leg trades, or even like, spread, that different spread activity? Like, can you decipher between that and single leg, or is it more that you really have to go to the volume print for that? You can just kind of see, okay, there's, 10,000 open interest contracts on the July 50 line, but, and also 10,000 on the July 60 line, but to really think, to know whether or not it was actually a spread, you really have to go back to the volume, reports.
Yeah, exactly. That's the thing with, once you kind of detect this open interest, change or open interest, cumulative open interest,
Mhm.
that's just one number there. It doesn't tell you the full story. And exactly like you said, it doesn't necessarily mean that if there's open interest on this one particular option, it came from just a single leg orders into that option. It could have been due to a spread, which gives you a different type of information, where this option increased, the open interest increase, but it was part of a time spread or a call spread. And that puts a completely different perspective on the trade and, what perhaps position is, held out there, or what the objective was behind that trade. When you're doing the calendar spread,
Mhm.
tells you something much different, or straddle, than if you just bought or sold a call out. And to do that, yes, you would have to work backwards and look at, like we said, well, what led to this increase in open interest? Let's say we're looking at increase. We'd have to go back, look at the volume, and kind of infer, sometimes you won't be able to. If certain trades stick out where, like, this is what, led to this open interest increase. If it was a multi-leg trade, you'd have to figure out what was that trade to understand it.
All right. And I want to kind of switch gears a little bit here, Dmitry and Will, and kind of bring in implied volatility into the picture, because, obviously such a big part of options. So, the relationship between open interest and implied volatility, can you decipher anything like, open interest rises and implied volatility is also rising,
Yeah.
versus like if open interest rises and, implied volatility falls, like
Yeah.
what kind of dynamics are at play here?
Right. So then we're bringing in different elements or factors of analysis to paint us a better picture of what's going on. And when open interest rises, then, that indicates there's more interest, there's more buildup in a position in this particular option. Well, the implied volatility. So we would go back and look, well, what was the impact on the implied volatility? Similar, like if there was a lot of volume in a stock, the next question is, well, what was the impact on the stock price? Right? Was it up or down? Well, that's how we would look at it from the perspective of options. What was the impact on the relative premium of the option? So if we're looking at an option where the open interest increase and the implied volatility increase from that trading, well, then the inference is that people were opening positions, with higher demand for that premium, right? Where the premium was getting pushed higher and those positions were held. Those positions had conviction and they're still holding on to those positions.
And in your webinar, you mentioned the concept of, implied volatility center of gravity.
Yep.
We really kind of, for our listeners that didn't attend the webinar, which is saved on our website, you can always go back and listen to it whenever you want. And I definitely recommend it if you're interested in the subject. It kind of means identifying at what volatility level, most open interest accumulated. How can traders practically, use this information for practical reasons and kind of price discovery and understanding where, the market found fair value?
Yeah. So when we keep track of the trades and trading implied volatility, because that gives us the benchmark, the indicator, well, what was the relative value of this option when we trade it, right? Because the option itself, it's going to decay because of time decay. It's going to change value because it has a delta. But the implied volatility gives us an indication of the relative value of that option at the time of the trade. And we talk about the center of gravity, we talk about, well, where is the most volume traded at what implied volatility? So we take kind of a VWAP measure of where we look at VWAPs of the stock, volume weighted average price. We could do the same thing with options using the implied volatility. And by doing that, we have a benchmark of where was there a meeting of the minds? Where did, a lot of the trading activity, at what level was it established? We could compare it to the current level, but this gives us an idea of, where the trading activity occurred and where the open interest still exists versus where the markets are now.
And you guys have, been trading options for a long time. Not to date you or anything, but not to make you sound old, but we've all been around for a long time. But what are some of the biggest mistakes or, maybe misinterpretations you've seen traders make when analyzing open interest? What does it tell us, and maybe more importantly, what does it not tell us, right?
Yeah, exactly. It doesn't tell us, open interest on itself doesn't tell us the intent, of the traders. It's a number. It's just a number that indicates something that we would have to go and further research it and make inferences, but it doesn't tell us, the directional intent because options don't have to be necessarily directional. It could be a volatility, a hedge, could be a spread. It doesn't update in real time like volume. So a lot of people look at volume and think that the open interest updates simultaneously with it, but that's not how it's calculated, because it's based on settled trades at the end of the day, and it goes through this overnight process. It's different than the volume, like we discussed. It's something where it tells us the existing positions, that are not closed out yet. So those are the common, I think, things people get confused about when they first look at the open interest, before they really start to analyze it and get more familiar with it.
Yeah, I think you kind of hit the nail on the head there. We sort of touched on in the beginning where, open interest could be 5 and, 5 in the morning, and maybe 10,000, it could be 10,000 opening, contracts traded that day, but you don't see it in the open interest till the next day. So
Yeah.
You kind of really nailed it on the head right there, where, you can kind of use it in conjunction with the volume, like, oh, there's only 5 open interests and 10,000 traded, so they must be opening trades. Whereas if it's 10,000 open interests and 10,000 traded, like, well, it might be opening, it might be closing. You don't know until the next day.
Yeah, exactly. Or sometimes you'll see strategies where, very deep in the money, for dividend, like we know, look at dividend plays and interest rate plays where we'll see a large volume, then it's all those options get exercised for that strategy, and there's zero open interest the next day because they were just exercised. So exactly, it could be confusing when you're trying to match up volume with open interest, unless you understand the different dynamics that go into both.
And, this is great. Is there any final thoughts you'd like to leave our listeners with?
Yeah, I mean, I think, as far as the open interest goes with options, I think it's a very valuable metric, very valuable if you use it correctly to kind of understand, well, how did we get here? If we see this open interest, not only look at it from perspective of, well, what is the open interest, but using that as a starting point to see, well, what was the history behind how we got here, really tells the story. It opens up the real story, not just the, top number on itself.
Guys, thanks a lot for coming by. For our listeners, you can find more from Will and Dmitry at marketchameleon.com. They also have a morning YouTube show that they run. And also on our website under education, you can find they'd run a monthly webinar, which is super informative if you're into options. And then we always do a podcast right afterwards to kind of continue discussing. Guys, thanks a lot, and Happy New Year.
Thank you.
Thanks, Jeff. Great job, D. Thanks, everybody.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.